Intercompany transfer of services and non-current assets. In this learning objective, we're going to look at the downstream sale of a non-depreciable asset or land. We're going to focus on the equity method of accounting for year one. And as always, we've got the current year activity between the parent and the sub. Then it'll consist of the net income and dividends, as well as the item we're going to focus on, which is the special allocation, any sale of land. Here's the parent's information and the sub's information. And as I said earlier, we're going to focus on the items of interest, which will be the sale of the land between the two parties. So we'll post or look at the various items that go with the equity method of accounting, but we're not going to spend a lot of time on those. We see the sub's net income of $90,000. This is the entry that's going to be recorded. We have the subsidiary's dividends. This is the entry that's recorded as well. And then the item of focus is the downstream sale of the land. Here's the information. On July 1st of the X1, the parent sells the land to the sub for $70,000. It bought the land previously in another year for $25,000. And then the subsidiary holds the land for several years and sells it in the fourth year. Well, just as a quick review, let's go through the process of what the parent did to acquire the land all the way through the sale, and then we'll look at what the sub does as well. When the parent bought the land, they would have debited land, credited cash for $25,000. In X1, the parent sells it to the sub. So the first thing we need to do is determine, is there a gain or a loss? We'll take the sales price less the basis of the land, which is $25,000, and we'll get a gain of $45,000. On the parent's records, they're going to make the following entry. They're going to debit cash for $70,000, credit land $25,000, credit gain for $45,000. What we need to ask ourselves is this gain stated correctly? Remember, the parent can only recognize any gain that they have when a related party sale once it is sold to third parties. So we have a general idea that it's not. The subsidiary is going to make the following entry. They're going to debit land for what they paid for it, $70,000, credit cash for $70,000. We can now jump back to the related party activity or the equity method of accounting, since we've kind of gone through the process of the sale between the two parties. We know that this $45,000 gain here is included in the parent's income, and we know that the gain is overstated since the land has not been sold to third parties. So what we're going to do is make the following current year activity entry. And we're going to remove that unrealized gain from the consolidated financials. Now, this is the entry we're going to make. We're going to debit income from subsidiary, credit the investment sub for $45,000. Now remember, under the equity method of accounting, any unrealized gains or losses or deferred gross profit that we may have is not going to go through any revenue or expense account. All of those transactions are going to run through the income from sub account. So we'll make this entry here. And if we recap everything, it'll look like this. We can reconcile the two incomes from the sub and the net income from sub. And since this is a downstream transaction, you can see that we're reducing 100% of the gain on the parent side. We've got book value calculations. We can also reconcile our investment subsidiary account. as well as our NCI account.